Hello, everyone. Again, I'm Ron Clark. I'm the editor of LOMA's Resource Magazine. We welcome you to our webinar today on adapting to the new insurance industry environment. LOMA is presenting this webinar in partnership with Workday, and we're very pleased to hold this webinar for our members since it deals with an important subject for the insurance industry. In today's competitive environment, keeping up with change is critical. Before we get started, here's a few little housekeeping details. This webinar is being recorded and will be available on the LOMA website in the near future. And we do invite questions throughout the webinar. You can use the Q&A icon, and there'll be a session towards the end of the panel discussion to cover the questions. So now let's go ahead and get started. We have two speakers today. They're Ben Etheridge. He's a principal managing partner for Workday, and Chris Artemenko. She's a strategic advisor insurance for Workday. And they're going to have a conversation between themselves about the current challenges and shifting business environment that insurance companies find themselves in today. This includes the impact of technology on insurance companies, the pace of change, and consumer and regulatory nuances. So now I'll go ahead and turn this over to Chris and Ben, and we'll get started on the rest of the program.
Well, hi, this is Chris, and thank you very much, Ron. I appreciate all of you joining us today. As Ron mentioned, my name is Chris Artemenko, and I am the insurance industry advisor here at Workday, and I am joined by Ben Etheridge, who's a managing partner. Most of his clients include some of our largest insurance clients. Both of our backgrounds are basically on your side of the desk. I spent most of my career in financial services and then came to Workday from Unum. Workday is a publicly traded company and a leading provider of enterprise cloud applications. It was able to start in 2005 with a clean sheet of paper, understanding everything from the technology and human capital changes, financial management changes, and really be able to build a brand new system from the ground up. As a publicly traded company, I do want to remind our representatives here on the phone that we might be making some forward-looking statements about Workday, and please don't make any assumptions or buying purchases on that information. And I would add that both my opinions and Ben's opinions are our own and not necessarily those of Workday. Well, wasn't it a nice, simple world that we seem to grow up with? I think it seems like it was easier. Once upon a time, you were expected to have one major path. You graduated, you started up the corporate ladder, maybe got a job, hopefully even a career. You're expected to get married, buy a house, take that annual 2-week vacation. You know, you got your benefits and your pension from that probably only one or two employers that you had in your career. You retired at 65, and you thought you might have a few golden years to enjoy. But isn't it true that maybe the rules of engagement have changed? That, maybe that's a Mayberry sort of world, that our culture really has continued to grow in numbers and in its diversity. We couple differently today, sometimes very sequentially, sometimes not at all. We might all not necessarily go to college, but for those who do, the liability from that endeavor might leave them in significant debt, debt that's going to impact other life decisions and timing of those decisions. Working for one employer and retiring at 65 with a pension and a gold watch, well, that just seems like yesterday. We do expect to have many employees during our working careers and maybe even be self-employed during some periods. Right now, the percentage of the gig economy is about a third. And, conversations about having a paycheck or doing what you love or going back to school, the perceived value of certain degrees, or do you study a subject for the joy of knowledge? It's all part of the new workers. But we do engage differently today, too, as a community. There's all the social networks that we have. And yet we're still very dependent on maybe having that life coach, somebody that we can really share opinions, even if it is by text. The pen pal isn't someone you send a letter to. I had one growing up. She was in France. And you wait months for a written reply. Today, it's a like on your last Facebook posting, and that was instantaneous. But, with all these new ways to learn and share, it's very interesting how much, information just seems to be misunderstood or just simply wrong. I found this on the internet, interesting barometer. And to me, it just really seems inverted. Why would younger people not think they qualify for life insurance? I'm actually a boomer, and I had the opportunity just a few years ago to change an old universal life policy into something more appropriate for my life age. And it never even dawned on me that I wouldn't qualify. I'm part of the 80% that just knew I would be able to get insurance services when I needed them.
Yeah, Chris, this has been, I agree. I actually fall into that Generation X box on the chart. And I would agree with your assessment. It does certainly seem inverted when we look at these numbers.
I think it's part of the problem we have today. And a lot of it is, there has been so much technology change. Yes, I mentioned Mayberry. That's a Mayberry phone. I learned to type, not keyboard, on a manual typewriter. We went from rooms full of great equipment to AS400s to laptops. And I would dare say now that, the phone actually is even the computer of today. And it really makes me wonder what's really going to come next. Because even though all of this technology changes and the social changes, business really hasn't changed. Our need, especially in insurance, is still to have good talent, to maintain profitability, that we want to preserve our culture if the company's just a few years old or over 100 years old. And we really, really do need to think about the future and plan for that future. And that's a lot to process and manage. So, with that, I kind of wanted to ask a lot of questions of Ben this afternoon. And again, thank you all for being here. But I really want to ask Ben what he thinks is keeping insurance leaders up at night.
Thanks, Chris. That's a great question. But first, I would like to thank everyone for being on today and spending a little bit of time with us. And also want to thank Loma for being such gracious hosts of us. So back to the question, what do I think keeps insurance leaders up at night? Well, I think I would stick with our theme here and say that, this answer certainly has potential to change over time. But right now, a couple of things that pop into my head are, I think, first and foremost, the potential for a huge claim event, right? Any kind of thing like we've seen in recent past with, severe hurricane seasons or flu epidemics, but also things like a rapidly changing regulatory environment. And then certainly, last but not least here, would be remaining relevant for policyholders and employees.
Well, Ben, we don't have a lot of time and maybe not necessarily expertise to discuss the regulatory environment, but I certainly appreciate that the current environment appears to be very ripe for continued change. IFRS 17 is something that I seem to talk about weekly. It's published just last year, and it takes effect in the rest of the world. What I mean by that is all those insurance companies outside the U.S., excuse me, and it has significant models and reporting of revenue going forward in 2021. And I have noticed that FASB is starting to talk about it as well. Excuse me. But I'm interested in what you meant by policyholders. Excuse me.
Well, Chris, like you said in the slides, policyholders are people, right? And people's lives are changing. Let's say I'm out of town and I want, a good dinner or something good to eat. I'm going to pull up Yelp or TripAdvisor or some application on my phone, look at some reviews and find that great local place to eat. Or if I hear the price of gas is going up, I've got a great app that's called Gas Buddy. I'm going to pop it open, see where the best gas prices in town are, and go fill up. And I can go on and on. I think you get the point, though. People, customers, policyholders, claimants, whoever, they're looking for an easier user experience with less forms, more online access, faster, tailored applications. And fortunately, I think a lot of times this experience is changing for them. But one thing that I've noticed is that while changing that customer experience has been a focus, not all companies have focused on the other customers. And by that, I mean the staffing or the employees of an insurance company.
Well, that is an interesting phrase, Ben. What do you exactly mean by the other customers, the staffing of the insurance company?
Well, most insurers have invested heavily in enhancing their customer experience through improved websites and perhaps mobile applications, but not as many companies have invested in their people as heavily. Some have, and they do a great job of it, but a lot have not. I remember doing business with a company several years ago, and they kind of banged on this drum that they called the virtuous cycle. You familiar with that, Chris?
Not exactly. How do you mean that in this context?
Well, basically, a virtuous cycle, or sometimes known as a vicious cycle, it's a fundamental, complex chain of events. And I think it's important to understand the order in a chain of events. So in this case, it's the thought that happy employees lead to happy customers. Too often, though, I think business leaders get this backwards and don't fully understand the real chain of events. So they believe the focus should be on the customer satisfaction, often to the detriment of employee satisfaction, and they don't make that connection. And it's really not a chicken and egg kind of thing. It's really just employee satisfaction is a driver for customer satisfaction.
Yeah, that is an interesting concept. I wonder if we'll get some questions, and people, can we put those questions in the Q&A section on their screen? So we might get back to this topic. But if employee satisfaction, in my mind, seems very nebulous. It's hard to define. How does one create, Ben? How do you think one creates employee satisfaction?
Well, I think there's probably a lot of different ways, right? But I think what I would say is I believe most employees, they want a pleasant work experience. And that doesn't mean perfect, and that doesn't mean butterflies and rainbows all the time, but just a pleasant work experience. I know that for me, I like to get new things. If I get a new car or a new house, that's really great and really nice, or even simpler and cheaper. Maybe new clothes or a new phone or new iPhone. We talked about technology, or things for my hobbies like golf or new golf clubs or a new bike, or even a donut, whatever it is. I like to get new stuff. And if someone were to give me any of these things, I really feel a sense of gratitude. But it's not even just about things. I think we all want to make a difference. We all want to feel like we're contributing. We all like to be heard. And we all like to have our work recognized. And this is especially true at the workplace. So let's say if my employer provides me with great benefits, an awesome work environment to work in, state-of-the-art technology, tools, systems, applications, hardware, you name it, I feel that same sense of gratitude. And these things can go a long way towards my satisfaction as an employee, which makes me want to work hard. It makes me want to give back to the company. It leads to a better customer experience because I'm providing a better experience for them, which ultimately leads to happy customers. So because of this virtuous cycle, today more than ever, I feel like technology in the workplace matters because it's how today's workers live.
Yeah, Ben, I really think maybe you're onto something. But, I've actually got an experience that is almost reversed from what we initially talked about. It was just a few years ago. I had just started at Workday, and my 80-year-old father, having had a long and happy life, passed away. So I had to call into his life insurance company. And it was just a little different than what we're talking about today with what they had done.
So elaborate. How so?
Well, we've mentioned that up front. You mentioned a lot of companies have been investing in those front-end systems, the ones that the customers might see, an app, for example. Well, in my case, this company hadn't done that, and I had to call in. I didn't have an app. I didn't have a browser where I understood what I might be able to do. So I was speaking with the customer service agent, and she was very sweet, offered her condolences, but I could hear frustration in her voice. At one point, and the call did take almost 15 minutes just to report some of those basics, his name, date of death, date of birth, the policy number. Did I have it? No, I didn't. And so she asked me to wait as her screen was still loading.
That sounds familiar. I think we've probably all been on a phone call with customer service or some form of support personnel and heard the "bear with me while my system is slow," right?
Boy, you got that right. And that's exactly what was happening. And not only was it slow, but she had to go to several screens to enter the various information. Oh, that's on a different screen. And she's sharing this information with me just to buy some time. So I didn't have an automation tool, and clearly she didn't have a good front-end system. But towards the end of the conversation, she told me that she would need to send me some forms and documentation, and to expedite it, she could email it. What's my email address? Well, I spend more time in front of my work computer and not checking my personal email that often, so I decided, and this was kind of an important thing, to give her my Workday email address. Then instantly her demeanor changed. I was just floored. She said, "I love Workday." And I didn't understand. She said, "I use your app all the time." I didn't realize she was a client. I did not know. I'd been so new. Workday, I didn't know this particular life insurance company was a customer of ours. She's like, "I can enter my time worked. I see my paycheck stubs. I even request time off all on my phone. I can do it anytime, any place. I work in a big office, so I even use it to look up to see where somebody sits so I can go find them." And here, it's a relatively sad situation. I became speechless. The call had been painful because of her slow operational system and her excuses. And I was trying to give her sympathy. Like you said, we've all been there. And then here we're talking about her delight at Workday. And I ended up just thanking her for sharing that enthusiasm with me.
That's a great story, Chris, and thanks for sharing. And I think it kind of goes along, backs up what I was just saying. Believe me, I think we've all been there. Anything that can make those back office actions easier is welcomed by employees. Whether it's something that makes it easier for me to serve my internal customers, because a lot of folks only have internal customers. We don't get to face the external customers ever. We just have our internal customers that we serve. Or just easier for me to request time off, like you said. Those little things can make a difference. I remember when I was first, quote unquote, allowed to wear jeans on a Friday in the office. That was obviously a very little thing. But for so many people, including me, it was a big thing. We loved it. It was casual Friday, right? I also remember throughout the years when various companies that I've worked for invested in and rolled out new technology. And I love those times even more. I'm kind of a tech person, right? That's what brought me to Workday. But before Workday, anytime my company would roll out new technology, no matter what it was, I loved it. Not everybody does, especially at first. I think we all go through change at different paces and handle it differently. But I think at a minimum, most people appreciate the investment that their company's making into their day-to-day activities.
Yeah, wow, that's an interesting investment in people. Have you ever heard of the Hawthorne studies? Just thought of that.
I have not heard of the Hawthorne studies.
It's Hawthorne, and said your comment reminded me of something I learned. I remember I'm a boomer, and I'm not sure everybody learns this anymore. It was back almost, oh my goodness, like 100 years ago now. It was in the 1920s, in the early 30s. There was a lot of interest in worker productivity. You think about the time period, a lot of factories in the United States, long before computers and Excel. Well, the workers at Western Electric were being studied because they wanted to know how to make them more productive, and the idea was maybe we could improve the lighting. So the team of experts turned up the lights, and productivity went up. So you would think, aha, they've got it. I had a theory. I've proved it. But they were some pretty smart efficiency experts back then, and they continued the experiment. They actually dimmed the lights, and I think they wanted to prove that, look, productivity would go down. But then just the opposite happened. It actually went up even further than when the lights had been on. So it really is, no pun intended, but the light bulb went on, and it wasn't that productivity was geared by the lights or up or down. It was the fact that they were being looked at, that the productivity was actually a byproduct, not of that lighting, but of management's interest in their employees, management spending time with their employees. And that fits what you just said, and I think it also highlights the need for better data. If they had stopped the study with the lights went up, we wouldn't have realized it wasn't the lighting. So the analytics, getting the right data points that are really critical for businesses trying to make good decisions and filling these top priorities they have.
Exactly. I think that's exactly it. It's about having the right information at the right time and in the right hands. I think, today we hear a lot about analytics. And I know that in the insurance industry, insurance companies in particular have a ton of data that they own. which requires a lot of analysis, right? But I think in my experience, and I think a lot on the call today could probably share in this, a lot of time is spent gathering data to turn it into information because there isn't sufficient time to analyze, understand, and take action on that recommendation. So we have people like business analysts and financial analysts by title, but in reality, they're data gatherers or Excel experts. And so we're hiring talented people, but we're not using the skills we really need them for because we don't have the technology and we don't have the means to get the information in their hands so that they can do that analysis. And that doesn't go very far to make them happy. If I'm an analyst by trade and I want to get in and do some meaningful analysis for my company, but instead I'm spending my time gathering data, formatting it and massaging it and get it in the way it needs to be, and doing all that leaves me little time to actually do analysis, it's not going to do much for my happiness or make me productive. So I think technology and people really go together, and people need to be at the center of that. Technology can drive customer centricity, innovation, operational efficiency, improvements in products, pricing, et cetera, but it has to be in the right hands.
You're right. We always think that it's technology that's the driver, but I really think it's a tool. It's that the talent does matter. But, it is important for us to remember when we hire them. I have heard of companies losing good talent because, like you just said, I got hired as a business analyst, but I don't feel like I'm a business analyst. I feel like I just try to figure out where all the data is. And today, when you're hiring a skill set, we tend to forget that 20-something-year-old, their entire life, they've grown up in an era where they grew up with apps. They didn't know what a green screen was. It's just a museum piece. They've had touch screens all of their lives. They swipe right. Even a mouse is considered old-fashioned. Like I said before, I learned to type, and now people learn to keyboard. But guess what? Now you can just talk, just like I grew up in the 60s as science fiction. You can talk, and you expect the system to answer you. I can ask questions, and I get an automatic answer. Yeah, so if I'm an entry-level person or even an MBA that, the company's hired for insurance leadership, fast track, I think those new hires, that talent, they expect the technology at work to be just as easy and just as powerful as the consumer experience that they've grown up with. No longer is, business, a lot of times I think business technology hasn't kept up with those expectations and the experience of the phone in my hands. And talent is so important. It really, really is. And I mentioned a little bit briefly with the gig economy and the 30% being and growing in terms of the gig economy and being self-employed. And I've seen it might be at least 50% maybe within the next 10 years or so. It seems to me that insurance companies, with their agencies, so having agents, independent contractors, they actually might have been ahead of their time. This is where the rest of the world is going. That system, the independent system, allowing individuals to have client relationships, and it's not selling as much as it is suggesting and educating. Do you see that changing?
Chris, insurance, I think, typically and historically has been a relationship business. I think today people certainly want that ease of self-service. But as you were just mentioning, I think, there's still a need for that coach, that social input. And I think you can only go so far with a self-service model. So, whether it be in person or virtual, I think that need for the coach or the social input hasn't gone away. So I think to answer your question, I think it's kind of a hybrid model now, right? It's a little bit of both, a little bit of self-service, a little bit of face-to-face or person-to-person interaction. I think that the growth of independent contractors beyond agents even is more reason to have cloud-based applications. You have more data, more information that you can share with folks in a really secure manner. I can see a future where people are the center in insurance. They have the right technology, information, tools, all to support the success of the business and the fulfillment of the workers. And I want to mention one more point. a diverse client base is always important for insurance as well, and they really understand the need to have risk mitigation. So, say, for example, insuring every house in a city is probably not the best business model, right? So that same diversity the value of that diversity, it's critical in their workers as well. So like a multicultural, multi-generational workforce brings fresh perspectives, you have kind of new ways and new methods to analyze data based on your backgrounds, new realms of clients and client experience. You feel more comfortable in making those relationships.
We talked a lot about talent, Ben, and I think you did make a great point. I mentioned earlier on about how, the world is changing. And sometimes I think we forget about the value of diversity. You're right, that risk model, no insurance company would just hire or, insure one type of all those houses in one area or look at, you mentioned the things that keep people up at night, worry about flu epidemics, and you want to have the diversity of geography, diversity of products, serving all kinds of clients, and yet there's tremendous value that comes in having that on your staff. And with the ability to work remotely nowadays and the contractors, the gig economy, the ability to have a wider range to be able to gather those people from. And it's also one of the things I was just thinking about was when you bring that kind of talent into your organization, you really do need to include them. One of the other statistics I've seen recently is, and obviously, there's various perspectives on this, but when you're hiring, we got a little bit more than 50-60% of our graduates from college are female. So about the 50% of people entry-level jobs are at that level. But when it comes to the more senior management, it really gets down to that 10, 12, maybe 15%. And it doesn't matter what kind of company, if it's an insurance company, a technology company, it's pretty consistent. So it really, that we've even hired better, but we maybe aren't including them in the technology decisions, asking them about the tools, including them in various meetings, and realizing that talent really brings value to the entire organization on so many levels. It's interesting that some of the topics we've talked about, and I have a feeling we could probably go on for a couple of hours, but one of those things I think we were talking about is, how businesses do win. And it's interesting, just sort of the comics that we've been talking about here are very similar. Those, as I was saying, that diversity, those people, as you just mentioned, bring differentiated experiences, and the talent is so important. While we think about technology being the tool, without the people and the right tools, it doesn't work. And that really leads to much higher productivity and therefore more profitability. And that goes back to what businesses need. We need to win. And with all of the market disruptors now that insurance companies have to worry about, they really need to focus on this. I know we want to leave some time, and I do see a couple of questions, though we could have some more. I just want to think about some of the takeaways that we wanted our audience to have today. And that is, as Ben and I have discussed, that the relationships really do matter. And he mentioned earlier using his gas buddy for finding gas in a place that he might choose it as a commodity, because saving a few cents on gas matters. But, when it comes down to life insurance, it comes to insurance, all of our financial services decisions, it really is not a commodity. You don't want to become commoditized. You want to know that your customers have more choices than ever, and you want to be able to have it easy to do business with them. You want them to have the products that they want to purchase. It really does come to being a relationship and an understanding. And the companies, with all the world being what it is, as I mentioned, it's changed, the customer now gets to define what's easy and what's relationship for them. So while technology has and does matter and certainly continues to have a profound impact, I don't think we could run the companies that we do today without technology. It is secondary to those employees and those agents and those agencies, and they will continue to be the most critical factor in your success. And just by, we hear about digital transformation, but what does that really mean? What does it mean for your business? It just means giving those people, meeting them where they are, and knowing that these tools can enhance, but they don't replace that experience that your employees and their customers have. I know we could probably go on. I do see a few questions here, and again, I'd ask if anybody has any others. We did want to save plenty of time. You are going to be muted because we do have over a sizable number of people joined us today, but you're welcome to add your questions into that Q&A section. And while we were talking, especially, I see one, but I'm going to start with you, Ben, because I see one of my here. It says, my company is over 100 years old. How do you think we could still be in business for the next 100 years? It seems like we're slow to change based on our legacy.
Well, I think that's a good question. And I think it's true, especially in the insurance industry. Many of the pillars of the industry are old companies, right? Very established, very successful, over 100-year-old companies. And often because of their age, a lot of these companies have a lot of baggage, probably is the right word, best one to use. A lot of baggage, the product of time, the product of numerous mergers and acquisitions, you name it. So I think there's a lot of things that, a company to be relevant or be business in 100 years, would have to focus on. But given that I think this conversation that we're having today is really centered on technology and people, in particular employees and customers, I think the first thing I'd say is leaders need to be willing to invest in new technology to enable growth, to enable employee satisfaction, and understand that that's not always easy. It's not just writing the check and saying, okay, we got the new technology. It has to be done right. So, every technology out there has a prescriptive way of being deployed or implemented. There's people that know how to do it. There's people that, on the flip side, don't know really well how to do it. So it's not just writing the check, but it's doing your homework and making sure you have the right resources to help get that technology stood up so that it can enable your business to grow and be positioned for the future. Second, I think, and probably more important, it may sound contradictory, but is be willing or be accepting of failure by your teams. I think we've all heard that term probably fail fast or smart fails. And I think it's very relevant, particularly for an older insurance company. I think leadership needs to not only be okay with, but encourage teams to make quick, informed decisions. Fail, fall down, but get back up. Keep going. Learn from those failures, course correct, and move forward.
That is interesting. The new companies may not have that 100-year legacy, and they may have the ability to be a little bit more nimble. Or maybe just because they're newer, maybe they thought about some of the things that we've talked about today, that, we do become entrenched. I said earlier, Workday had a clean sheet of paper. That's not something that everybody gets a chance to do. So how to do that and use the benefit of that history, the benefit, the strength of your brand to say, we've been here for generations and we're going to be here for generations. But knowing that they've got to have those people who are happy employees who are going to drive those happy customers. I was coughing a bit, so I think we've got somebody, I appreciate them asking this question, that I mentioned IFRS 17, that FASB might give us similar guidance, if I could expand on that. Well, and for those of you who may or may not be aware of, IFRS 17 is all about revenue recognition. It's not how you do business, but it's going to be on how you report it. And as I said, it is a global, but it's the U.S. companies, especially companies who are not having any kind of touch of the rest of the world, are not under this guidance. It does require a contract-level analysis of cash flows and the payouts over your coverage period. So again, short-term contracts like P&C are not as impacted, certainly, as life insurance companies are, because you're going to have to discount to the present value of those cash flows. Your income reported for your period is going to be based on the cash flow, the expenses, and even the time value of money. You've got your CSM, your contractual service margin that will be also an estimate, but your expected profit needs to be booked on the balance sheet. So those estimates are going to have to be revisited routinely. So again, it is designed to create more transparency for insurance companies to be able to compare with their performance with their peers, for the policyholders, for the investors. And I really do think that's one reason that FASB is going to provide some comparable guidance. I think they're going to wait and see how it plays out. Again, it starts in 2021 with a lot of companies running 2020 in parallel, so they can be able to explain in those annual reports the difference in some of the estimates I've seen could be up to 40% difference in a reduction in income at any given period based on this time value money discounting in the models that are being used. So I do think that insurance companies in the U.S. really do need to be aware of this and have the benefit of time in their planning, because it really does take quite a bit more of technology. Unfortunately, this is what technology does really well. It computes to be able to run every insurance contract, not just families of insurance, but the individual contracts to see how those are impacting it. Ben, I see we've got one more. Maybe both of us can kind of give our opinions on this one. The question is very simple. What is the biggest disruptor for the industry?
Yeah, Chris, that's a great question. I think from my perspective, and you kind of hit on it just a minute ago, but the insurance industry is well established, and most of the key players have been around for a while. I think that the biggest disruptor is going to be a newer insurance company, somebody that doesn't have that baggage that I talked about and can be very, very nimble and very responsive and kind of change things on the fly. So I'm thinking of companies like Zenefits or Bestow that are focusing more on the technology side of it. So using cloud, software as a service approaches, or all online with no medical exams, those kinds of things. Now, in my opinion, I don't think anybody's quite got that right yet, but I think the ability for these legacy insurance companies to quickly adapt and change to these new models that are coming into the market is going to be key for their success. So I think that change in approach, that change in the way that the insurance is offered to the consumer has potential to be one of the biggest disruptors for the industry. Chris, I don't know if you've got anything you'd like to add to that.
I think that's huge, and I think it goes to some of the things we've talked about today, that the newer disruptor, if you will, doesn't have that technology debt. They don't have that service of, systems that they might actually have from a merged company that came from the 70s, 80s, or having to support, 3 or 4 versions of something because, again, companies and different purchasing decisions, from either mergers or acquisitions, or that simply decisions that they made, where a newer company has that clean sheet of paper. But I also think, that the customer itself, and I'll go with those internal and external customers to add to our conversation, the customer's expectations is for that kind of service model that I unfortunately for financial services, you can't get rid of a channel. We've got everything in those millennials and the X's and the boomers and the seniors where I want somebody to call, or I want to swipe everything on my phone and never speak to everything until I want that life coach. And I think the client expectations can be a bit disruptor. They don't understand, they understand they need insurance for their cars because, the lender required it, but not the value necessarily that they're getting from it. I think sometimes we've forgotten, maybe some of those Mayberry values and why life insurance is so important. I've got a nephew who spent years, I'm talking, 13 years becoming a doctor, and one of the questions I've got for them is, all this investment that you've had and, now you've got 3 children, but, have you protected that? What is the do you have insurance? I remember my mother telling me, that when we were talking about insurance, because my mother trained me. She talked to me about these things. And I'm not so sure that that's being done today. So I think between the new companies who are building, I believe, on those new expectations of the customers really are what is disrupting it. I see a few more questions there. Thank you, audience. So I've got how the technology can help keep you in industry. I'm not sure if I understand exactly how they mean that. So how can the technology help? I think that's the question. Maintain your relevance. Ben, you want to start with that one?
Sure. Yeah, I can start with that one. So I think, I think you got to pick the right technology, right? I mean, technology should not define the company or define, who the company is. The company has already done that or has to do that on their own. They've got to kind of define their own legacy, set their own vision, build their own brand, and then choose the right technology to enable that and to enable them to build and to establish that and ultimately to grow it. I don't know, Chris, if you got anything more to add on that. That'd be my take on that one.
I think picking the right technology, and I'm going to expand on that, Ben, and say picking it the right way. It's amazing that I still see people putting out the same RFP, request for a response, a proposal, was the same one they sent out in 1995, the last time maybe they upgraded something. They just assume these are the features and functions we need, and they really don't take a look at that. They don't realize that their systems or their process should have changed, and that kind of leads me to the second reason that kind of is a tangent, where the technology can help. So it's the right technology, but it's also the right process to get it, ask new questions, and then also be open to the fact that it has changed. If you take an RFP from 1995, not recognizing that your processes should have or could have or may have changed, that your customers, both internal and external, have changed, then you're basically asking for a newer version of the same old thing. And we call that in this world lift and shift. And that really doesn't work very well. If you really want the technology to help keep you in the 21st century, you really need to, take that step back and say, not only what technology is relevant, but how should we purchase it? I always contend that an insurance company's back office, the schematic looks like you took a bowl of spaghetti and dumped it on the floor. That, I bought a system, I needed something to hire people. I needed a general ledger. I needed, let's do some procurement because we're going to save money by having managed spend versus every, office buying their own things. So along the way, I bought system A, B, and C, and I didn't worry about connecting them. And somehow my IT department might just, sometimes they just do what they're told, and, these are the decisions, I'm going to do the best I can. And it ends up with that spaghetti bowl on the floor. And I think that would be the way I would want to fix it in the future, is I would really want to say, what kind of company do I need to be, and then what kind of technology? And really look for, something more simple, more elegant, something where I don't have to worry about hardware changing over time, because these are the things that have been the issues in the past. And I think, going forward, as you mentioned, Ben, the new people don't have that debt. So you need to become as nimble and as forward-thinking as some of the newer contenders who are asking for the business from those same customers you are. I'm looking for any other questions out here and not seeing a whole lot more.
Yeah, there's actually one more here that I see. It says we spoke about top business priority but didn't really speak about customers' loyalty. First priority needs to be loyalty if we want to maintain profitability or plan for the future. Do you agree? Well, first, yeah, absolutely, I agree. And second, I'd say, we probably skipped over that. So thanks for calling this out. We didn't really talk a whole lot about customer loyalty, but I think the principles apply, right? So as we look to modernize, we look to kind of build these front ends, newer websites, newer applications to attract new customers, those same things will attract existing customers and keep them coming. So, if I've got a P&C policy through carrier A, and it just gets harder and harder to renew because they keep sending me renewal forms in the mail, and I got to fill it out, stuff it in an envelope, throw a stamp on it, stick it in the mail, and wait. Or carrier B, sends me an online form that I can do, just as fast hit send and get an updated quote and renewal within seconds. I might be tempted to move to carrier B just for simplicity, assuming rates and services and things are equal. So I think the same thing applies to existing customers as it does to attracting new customers.
The one thing I would add to that is sometimes as a loyal customer, I see those ads, and I realize I feel like the newer customers are getting a better deal than I am. And I feel like I get better when I'm a first-year customer than a second or 10 or 20-year. And yet there is that, it's hard to change. I mean, I think some customer loyalty is just customer inertia. But I always want to feel like I've been with you the whole time. Make me feel as special and as welcome as that new customer. And I think, we are, I want relationships. I want to feel like I matter to you, just like the employee needs to be heard. The customer also feels like they've got that same kind of loyalty from you, and then they return it. And I think that's very important. One of the things I've often heard is college students will usually maintain a banking relationship, and I would think it's the same with insurance with the first person that gave them a credit card, that first car loan. So if you are the first, if you meet them where they are, maybe it's payment plans, maybe it's special discounts for college students. We know that they're usually the most expensive ones to insure. So how do you do that? How do you introduce life insurance early in their life when they realize this is something, obviously it's less expensive. I know when I started with Workday, I actually had an Unum policy from my previous, a disability policy from my previous employer, and I wanted to move it over, but I couldn't because I was 10 years older. And, I didn't want to, but they were good enough to tell me it would cost. I thought I would have the convenience of payroll deduction, and it was, no, you're 10 years older, so we would charge more. So, just to make sure that those customers know that you're in it for the long run, that you have, especially the legacy ones. You're 100 years old, you're 50 years old. You've been there when our parents needed you. You're going to be there when my grandchildren need you. I've seen some commercials that really seem to tie on that service level, and that's just as important. Ben, have you seen any other questions out there?
I don't see any now.
I don't either. Well, I certainly appreciate everybody's time, and Ben, it's been a delight to have this conversation. I'd like to continue it very much for us, but I think I'm going to turn it back over to Ron.
Okay, thank you, Ben and Chris, for that interesting conversation. We also thank our members for taking the time to attend this webinar today. We know you're very busy. We appreciate you taking the time to listen to this. A reminder to everyone, this webinar it was recorded and it'll be posted on the LOMA website in the near future. And we'll send everybody an email telling them when it's up and telling them where to find it. So I guess we'll sign out for now. So thank everybody. Have a good day.